A very good morning to the members participating in this program. It's my privilege to introduce today's speakers. Both of them, Anjan and Nataraj, are our own BBA members. I'm delighted that our own member, I got an opportunity now to introduce our own members. Mr. Nataraj Nanjundaya, he is practicing CMA, IP, and SFA valuer. He has 24 plus years in finance, HR operations, process transitions, operations, excellence, and global stakeholder management. He has worked with ADP, Infosys BPO, Amazon, and Deutsche Bank prior to starting his practice. He is a regular speaker at various institutions of repute. And the second speaker for today is Mr. Anjan Babu. He is the founder and practice leader of Anjan and Company Chartered Accountants. His experience in practice covers valuations, financial reporting, taxation, financial modeling, and consulting. He is a regular keynote speaker at many seminars and conferences. He is also a visiting faculty at various professional and academic institutions. Over to you.
Yeah, thank you, Shilpa ma'am. So let me begin first by just giving acknowledgements and credit to all the people who are due. So one is, of course, gurus are like gods. So there's no point in learning if we don't thank our gurus. So I thank my gurus, especially one of whom is Abraham sir, who has guided me a lot and mentored me from the nascent stages of valuations till now. So, and he has done it in a very selfless way. So that is due acknowledgements to him. I also thank BBA, and the BBA Managing Committee, which from its beginning days has been very consistent in organizing programs of very high quality and bringing in the best of speakers. I feel very privileged to be even to contribute a little in that esteemed panel of speakers that BBA always put forth, and I feel very humble and small in front of. Then, of course, no thanks is due, because this program, I am able to speak in this program because Nataraj sir pushed me to get into this, and I thank you very much, sir, for that. And no thanks is left out without thanking Shilpa ma'am. She ensures that I put forth my best act here, because she calls me up even a couple of days before the program, telling the high expectations that the BBA members will be having. So thank you, Shilpa ma'am, for that, for motivating and for organizing the program. Vijaya ma'am was there to help us coordinate for getting the flyers out, coordinating with the members and all of that. Thank you, Vijaya ma'am. And of course, the learned members of BBA who constantly push the speakers to come up with their best and put the highest of standards for the platform. So I thank all of these, and of course, with all of these credits and acknowledgement, there is one discredit is for me. I whatever we are speaking as of today, I do not claim to be an authority on it. In fact, many of these things I'm yet to implement in my own practice. These are new learnings, and that means there will be mistakes ahead, which you may expect the mistakes. And if I make a mistakes, please do correct me. Coming to which, disclaimers, whatever in the presentation is not to be taken as a legal advice or a professional advice. Instead, it is a general information purpose only. Whenever you're using this material, please use your professional judgment. You do your own independent scrutiny of this material if you ever have to use it. And in case if you come across mistakes, please do tell me. I would also learn about it. The views expressed here, whenever I am speaking, it's my own views. And whenever I am presenting, it's my own views. It's got nothing to do with the views of Bangalore Valuers Association, nor is it of my firm, Anjan and Co Chartered Accountants. Nor when I am speaking, I am expressing on behalf of Nataraj sir, or when Nataraj sir is speaking, he's not expressing views on behalf of me. So errors do occur. So in case errors occur, please be forgiveful of that. All right. So this is the flow of our discussion today. So for the first 5 to 10 minutes, We will take a quick survey of our own members here. There are about 20 members online now. So we will try to get an understanding of how you are using CSRP in your own practice. What are the challenges that you're facing? It's a quick Q&A plus a discussion kind of a thing. I will ask the questions in the beginning because later you will scrutinize me with questions. So let me ask the questions right away to you, right? And you guys share your opinions on what is happening and all of that. You can be vocal by either unmuting yourself or you can put it in the chat box. Then we are going to study a little about the case laws that are surrounding CSRP and why we may have to, as valuation is still its nascent stages in India, why we may have to relook into how we approach CSRP. Then Mr. Nataraj is going to speak on the unsystematic risk considerations, scrutinizing the CSRP assumptions. Mainly, he will take a qualitative approach to CSRP. That is going to be for about 20 minutes. So after all this, then we are going to get into a very computational mode on how to get into CSRP in the most structured way possible. So that will be, and then this topic I have not yet discussed with many members, so I'm not sure whether members are using whatever we are going to propose to be applied in a practical way. So I'm pretty sure there's going to be a lot of discussions and question and answers. So that we have kept for about 20-25 minutes. That will all add up to about 110 minutes. 10 minutes we lost now. Okay. So what should be this is the Q&A. I'm opening up the stage for everyone. So whenever you get a valuation assignment, in your opinion, and you can be wrong about it, right about it, there's no right answers here, or there are no wrong answers rather. So what should be the ideal company specific risk premium range in case you take up startup valuations? Yes, anyone?
Anjan, what normally I do is I see the rationale of the projections. Okay. Bottom line, more or less, there is a sanity, but top line, it's all insane. Okay.
Right.
I don't know who has told them dream big and all these things, your valuation is, they want to pump up the valuation. That is why they think, they will increase the top line. At least, if even, God comes and helps them out in their pursuit and efforts, still, even God also cannot achieve the top line. That is how I get the projections. I don't know about others, many of the times. Okay.
Correct.
Especially with startup, especially with pre-revenue. Okay.
Correct.
So no matter how much we try to tell them, they will not. Okay. Few of the almost, more than 50% or 70 to 80%, I'm able to convince them. At least, the best possible scenario, give it, but don't go on an even best possible scenario, again, probability plays. Okay. Without all of this, if they give the projections, I take around 25 to 30%.
Got
I'm
it.
not able to touch or I'm not able to impress upon them.
Otherwise, have you ever taken something like a 50%? Have you come across such kind of projection?
30, I went 30, 35 once. And
right.
That's it, not beyond that.
Right.
But otherwise, normally it will be in the range of 50 to 20%, other than a matured. Matured, I stop at 10.
Right.
If
There's a
I try to
answer on
put some
the chat box
rationality in the
also.
projections.
There's also some answer on in the chat box that says around 20 to 25%.
Members, I request you to unmute yourself and share your experience. Even Anjan will get an idea as to how others are speaking, and while you are speaking, others will get to know, from your experiences. Please speak out. Mr. Chandrasekhar, you can say, Vandana, Chirag, Mr. Uttam, Jivika, Senthil, please speak out. Mr. Gangadhar.
Yes, can I? Ideally it is on case-to-case basis, and while as Silpa said, first you have to see the company-specific risk premium, and we say that risks which are affecting the cash flows, we can evaluate the cash flows first. If the risks are affecting the cash flows, if those cash flows can be adjusted because of the those risks, whatever that adjustments can be done to the cash flows, that will be taken care. And ideally, in such cases, we can go with either build-up model for the discount rate development or CAPM, traditional CAPM. No need to make any additional adjustment for CSRP if the cash flows got adjusted of because of the risks that are anticipated by the company or the evaluator.
So
having said that, there are some risks which are specific to the industry or specific to the company, which cannot be just like contingent liabilities. We may not be able to adjust them in the cash flows. Sometimes we may, sometimes we may not be able to adjust them in the cash flows. So in such cases, it is one example. So we can adjust them in the, we can make some adjustments to the discount rate. And having said that, as Mr. Professor Mayers, I think sessions heading is also that you cannot bring something, you cannot fudge the numbers or fudge the project by taking some arbitrary number of CSRP. When you are doing that, you should have some rationale and logic. So when we develop the discount rate, obviously we should evaluate all the parameters. Yes, this is the statement that has been given by Mr. Mayers, Professor Mayers. In fact, it is in the book, it was written, but it was given by Mr. Mayers.
Right, very true, sir.
So you have to take all those things into consideration while developing the CSRP. So I think in the qualitative parameters and quantitative parameters, you will cover that.
Right.
Thank you.
So I usually to take based on sundry factors like completion factor, financial strength, management strength of the debtness, and several other factors. And we used to allocate the 1, 2, 3, 4 as the and add up. So whatever the value figure we get, that we take the CSRP. As stated by Mr. Parallel Black and Robert Green model. This is called.
The Robert Green.
And to what extent I am to you sir just explain me whether I am to what extent I am doing correct or not. Just please.
Right, sir. Sure.
Sometimes you also make adjustment towards size premium. That is one kind of CSRP. And the industry risk premium also you can make. After all the adjustment, again, if you go for another, adding another number, sometimes you match with the Professor Mayer's statement, or sometimes you are making the right adjustments to the discount rate.
Right, sir. Right. So, I get it. So what, am I right in, sir, your name is Gangadhar, sir, no? Oh. Who I couldn't recognize. I heard Sanjay sir, but I couldn't recognize who spoke about the adjusting the cash flow Mayers and all. The speaker.
Gangadhar.
Okay, sir. So Gangadhar sir has rightly pointed out a few things, in fact, which will get covered later in our sessions as a part of case laws, where there has been heavy criticism on using risk premium as a fudge factor to adjust any cash flows and adjust inflated cash flows and all of that. And Gangadhar sir has rightly pointed out your risk premium can be very low if you have pretty much adjusted all your possible risk factors in your cash flows. So we will come to all of that. So coming over here, we got some really intelligent answers. So Sanjay sir mentioned about the Robert Green approach also, which takes into account all the qualitative factors that goes into computing a CSRP by giving them appropriate risk ratings and rankings and weightages and things like that. So I am not going to be covering the Robert Green approach or the qualitative ranking approach, which also has its own merit. But in fact, this particular session will be a critical examine of those kind of approaches rather. So here I couldn't establish a range. Some are about 25%, some are 15 to 25%, and then Some are giving very intelligent answers like Gangadhar sir, which is a very logical answer. So, and then there are logical models of using CSR. All right. So another, I'm not going to answer these questions because we'll revisit these after the end of the session. So where should the CSR be added? Should it be added to the cost of equity? Should it be added to the cost of debt? And should it be added to WACC? It's a very straightforward, simple one.
Normally, I add in cost of equity.
Right. Anyone else have any other answers?
The cost of equity, CSRP just risk added in cost of equity, sir.
Right. Thank you, Sanjay sir. So I think the rest of the class also agrees. Yeah. So next thing is, which of the following situations warrant usage of a higher company specific risk premium? Okay, like subjectively higher. When I say higher, it can be anything about 25%. So it's just comparatively subjectively higher. So when the subject company experiences more qualitative risks than the comparable guideline public company, that means there is a comparable company and this company. If the comparable company has lesser risk and our subject company has more risk, do you use high CSRP then? Or as Shilpa ma'am had pointed out, if there are overly optimistic free cash flow projections by management, do you use it that time? Or if, let us say, there is a transaction that happened and an industry peer got a lower valuation in the executed fundraise transaction, do you use a higher CSRP that time? Because the fixed inputs like risk-free rate and risk premium, all of these, equity risk premium, all of these are fixed. Beta would also be fixed because it's similar industry. So would you use CSRP that time to bring in the kind of valuation multiple that you're looking at? Or was it that you are valuing the company for the second time, or the value has been done in generally but second time? The last time a certain projections were given, and in actuality, when those years progressed by, the revenue targets or EBITDA targets did not get hit. So would you like to use a higher CSRP that time? Or is it all of the above situations? Or if it is none of the above, you can please share your situations where you give a higher CSRP, let us say.
Actually, Anjan, I have a critical view on this point. See, majorly, okay, I understand many factors play into, the future prospects of the company, but majorly it's the product. Okay, as a valuer, I will have a limited judgment capacity to understand what is that niche, what is that USP which they are bringing into the product. Okay, at any given point of time. They may explain me hard, but then I may not understand it the way a technical person or an investor understands it, if the investor is a technical, technically expert. So there I feel fall short of my, judgment. I'm always wondering, I'm considering many other factors like what you have considered, but is the product viable? Is the product, will it test the, market, success? That I feel, how can I as a valuer, because everyone tells they are good only, according to everyone, they are Ola, Uber, or, Unicorn, Byju's, they take that example that aspirations are good, but how good is that technically? Just as a product as it stands. There
so
also,
you're looking at some sort of a moat in the industry, right? So this person should
I'm not able to judge by the words they give or by the matter, by the information they give. I will never be able to judge, whether the product as such stands at A grade or C or D grade. That is where I always have this, all these parameters. Yes, to some extent we are observing, but there I feel, because we don't have any certification as such, right, about the product in place.
So it depends on the business model and the products that they're offering. And in case if they're very
all of
generic,
this is superficial, right?
Right.
So it's more of superficial, but the real thing somewhere, I don't know.
How are you quantifying it, ma'am? So like, for example, let us say there is one product in a very heavily crowded market. Okay. And let us say you have to do the valuation of it. Is there any way you have
No, I
developed
don't
for
have
yourself?
answers for this, but then I always have a doubt,
Right.
as to where do I stand. Okay, considering, see, all these parameters normally, we observe, we check, I account it or not, again, it's a separate issue. But then that thing, and majorly, if really it's a very good product, no, because they want to stand out and they want to contain this USP, they will not even share with me, anything of that sort. They will not share any of their trade secrets.
Right, right.
Yeah,
So
actually,
I will be a private to that information.
Shilpa, this specific point I will be covering in my presentation, and you will understand exactly this scenario, what needs to be done. And I have also faced this 2-3 times when we are doing, especially a startup valuation. Their product is very good, but they want to compare to Amazon, Flipkart, and Paytm. But how that particular thing can be solved, or rather addressed, it would be better if I address that question when I am in that particular slide, actually, because otherwise I will be talking on the 7th slide instead of first slide of mine. So please park that question and we'll address it.
Yeah. So then the last couple of questions, and I got most of the answers as all of the above in the for this question. So all of the above was majority of answers. So now finally, already Gangadhar sir and Sanjay sir have shared how they use a CSRP, and even Shilpa ma'am to some extent has shared when and what type of methodologies are being used in their own practice for CSRP. So which of the following do you use in your practice for arriving at company specific? So one is rating qualitative factors and assigning ranks and computation of risk. Then the ICI RBO insights on valuation series, valuation insights, I think volume number 6 or volume number 4, I forgot. There is a certain ranking methodology that they have given out, and any deviation over that gives a certain computation of risk premium. So is that one? Or do you have some sort of a range of CSRP based on the type of company and your own inbuilt model? Then there is the total beta method, or from using the total beta, you get that CSRP through the Butler-Pinkerton method. So do you use that in your practice? Or do you use a differential factor to arrive at an acceptable valuation range? That is basically like, for example, you're valuing a software company and you understand that the software company has in general in the industry, has a turnover multiple of twice or 2.5 times, or EBITDA multiple of 8 to 10 times. So do you do your market research that time and then change your company specific risk premium so that the valuation matches up to those industry established multiples? So do you do that? Or build up method? We heard about build up method by Gangadhar sir. And if any other methods, if you're using, you may please let us know which of this. You can either put it in chat box or you can, right? So I got an answer on the chat box saying that one valuer madam, she uses industry established multiples, right? So that is one way of ensuring that your valuations are in line with the industry commanded values. So any other answers? All right. So I will be moving ahead on this. I'm not getting much answers, but
I just want to add here, I know I will actually take into consideration a multitude of factors. It can be anything from, customer concentration or, the economic risk or the, profitability of the company, the corporate governance,
right.
the competition.
So these qualitative factors, are you drawing from any material or do you have developed it yourself?
No, I have not developed it myself. I can only tell you that much. So it will only be drawn from, whatever information that they actually,
right.
the information that they share and whatever is the analysis that we do.
Right.
when comparing the industry.
And you sort of give a grading for all of that, and you understand how much CSRP you have to charge. Is that right?
Yes, yeah. Taking into consideration a multitude of factors, which possibly fits into whatever you are actually, like the first one that you are telling, rating of qualitative factors and assigning ranks and computation of risk.
Risk. So yeah, you're going by that method.
Yeah, that's correct.
Right now. Yeah, thanks. All right. So, and then the final question, after which we will get into the session. So keep all these questions in your mind, and let us see how your opinion of all of these changes over the course of the session. So final question is, let us say if some company is really good, is there a situation that warrants 0% company specific risk premium?
You're talking about startup scenario or a matured company?
It can be anything. It can be, is there
So
any situation?
If it's a matured company and the historical trends are maintained, all the ratio analysis is, what it's matching to the historical trend and also matching with the peers in the industry. Because already certain, factor is already considered as beta, industry beta. So this company specific risk in that case, I feel could be 0.
So to put it in other words, this company will face only systematic risk measured in beta and no unsystematic risk. I'm not talking about theoretically, I'm talking about practically. Okay. Theoretically, yes, you can design a company with 0 unsystematic risk and only be having the problems of the market. But is there a situation? So I am getting a mixed bag of answers. So Shilpa ma'am had vocally told yes on behalf of many people, the yes gang, we will call them. And then there is a gang in the chat box which vehemently disagrees with the fact that there cannot be any companies with 0% risk premium, right? So where do I stand? So I will answer this one question and then I will go on to the other stuff. Where do I stand? I stand somewhere in between, you can say. There is a theoretical side to it and there's a practical side to it. So let me explain the practical side and then we will get into the theoretical side. So one of the companies that is consistently chosen by the American US scholars and professors in understanding valuations better is the ExxonMobil. Like that's ExxonMobil, that the oil company is usually used in many of its various studies because it's one of the longest companies that's out there and it consistently earns very good money. It has got a good moat around it. Even though ExxonMobil, we may have the impression that they are fossil fuel based company, they have done various investments and expansions into clean energy as well, and they are everywhere in the world. So you can say it's the big daddy of companies, not just in US, but all over the world, and with sufficient data sets going back centuries, right? You can get almost a century of data from ExxonMobil, be it its annual report filings, be it its stock price. It's one of those earliest companies to be listed in the stock exchanges. But it's not the earliest, it's one of the earliest. So that means it's subject to a lot of research consistently. And believe it or not, a company with market capitalization of that of ExxonMobil having such consistent performance, there is a computation done which indicates it experiences 3.5% of company specific risk premium. So the market has sort of calculated and codified in the share price movements about 3.5% of company specific risk premium. This is the practical thing, and based on the various studies conducted by the Duff and Phelps and a few other academic organizations which are really in the frontiers of valuations, you can say. Even BVR, that is valuation series, right? So they have also conducted research into this, and they also stand by the Duff and Phelps observation that around there can never be a negative or a zero CSRP because unsystematic risk is a reality and it will always be there. So this is the market approach to things. Now, I would like to expand a little bit on what Gangadhar sir had told that time. If the cash flows are adjusted to such an extent, the company has brought in all the possibilities of risk into its expected and projected cash flows. You need not have company specific risk. Um, However, I feel, in my personal opinion, it is a utopian ask. We can do various scenario based, irrespective of what kind of cash flow the management gives, some optimistic, extremely optimistic, or pessimistic. Whatever the company hands it over to us, if we identify the risk factors properly, we can sort of do some scenario analysis and model it in and come up with some sort of a mean or an average distributed cash flow. Which accounts for both the optimism and pessimism. But in many of the companies, the number of variables are so high and the permutation of such variables coming together, all of that can be a little bit of a challenge. So in my opinion, whether you take a scenario analysis or a weighted average sort of a cash flow to counter in and compute in all the possible risk factors, I still feel there is a CSRP that can be there, even if not at least a minimal CSRP. So, because 4-5 things together can make a very bad thing, or a one single thing out of the 4 possible risks can become a bad thing, or a few good things can make it a really good project. So in my opinion, all of these multiple probabilities and scenarios are very difficult to bring it into a scenario based analysis of cash flow and bringing it into a probable cash flow. So some sort of CSR. So there is no definitive answer, but I can only give you these facts. So now I'll be looking at some of the case laws majorly being decided by the Delaware Chancery. It's one of the highest or the prime business courts in US, because as you know, majority of businesses, startup enterprises are set up in Delaware because of their friendly tax atmosphere and the administrative atmosphere for businesses. So Delaware Court of Chancery has come up with various case laws in relation to valuations. So we will look at that, right? So reading these case laws should be motivating enough factor for all valuer fraternity to relook at how we approach company specific risk premium. So one of the most contentious case law is the Sunbelt Beverage Corporation. I think it was Chancery Chancellor Chandler who gave out this verdict. So the valuer had used a company specific risk premium in the valuation computation. And what Chancellor Chandler mentioned is they rejected the Sunbelt's use of CSRP. And the reasons given by the expert, that is the valuer, were not company specific, but rather applicable to all industry participants. So there was no company specific reason given by the valuer for adding on more premium. Like for example, if we tell no, the cash flow projections were very optimistic and that's why I had to use a company specific risk premium, there's no company specific problem there. The problem is with the cash flow, but the objectively the company speaking in the back end is the company by itself. So if the cash flows were optimistic, then we had to do something about it rather than add and call it a company specific risk premium. And also there were other criticisms also, right? Like for example, the management is young, inexperienced, and some managements comparatively are highly experienced. But it's a very blanket statement which cannot be really quantified into anything worth using and bringing it into the specific risk foray. So that is why the court vehemently rejected, and they told there's nothing specific. The court therefore implied that the risks intended to captured in CSRP were already captured in the discount rate that was estimated based on the industry participants. So what the court was of the opinion was, you have the risk-free rate, you have the equity risk premium, ERP, then you have the small company premium, then you have the beta. So all of these are actually already covering your company specific risk premium. There is nothing more you need to add on to it, was the opinion of Delaware Court of Chancery in the case of Sunbelt Beverage Corporation. So this is more of a recent one, MRI radiology. I think it's a 10-year-old case law. So here what they told was the calculation of a company specific risk is a highly subjective and often is justified as a way of taking into account competitive and other factors that endanger the subject company's ability to achieve its projected cash flows. It is often a backdoor method of reducing estimated cash flow rather than adjusting them directly. Okay, so basically they are hitting us where it hurts the most. That is, it's an open secret, right? Where it's a backdoor method of reducing estimated cash flow. So this is what some of the majority of the valuers do, and the Delaware court has openly criticized it. So it further goes on to tell, and this is a very intellectual understanding of CAPM, or a very pure understanding of CAPM. So if anyone has truly understood CAPM, they realize that CAPM cannot be tampered with, right? You have the risk-free rate, you have the equity risk premium, and maximum you can add the small company premium, but it captures systematic risk, and it is not supposed to capture any unsystematic risk. So pure proponents of CAPM argue that only systematic risk as measured by beta is relevant to the cost of capital, and that company specific risk should be addressed by appropriate revision in cash flow estimates. And the reasoning behind why CAPM does not capture unsystematic risk is, one of the core assumptions of CAPM is that the investors are going to diversify their investments. So there is also that famous study, right? If you have sufficient amount of securities in your portfolio, the unsystematic risk reaches zero. Like if the number of securities in your portfolio, if it is reaching infinity, the unsystematic risk will reach zero. So the CAPM concept takes into account the profile of the investor, and it is assumed that the investor is diversifying and being very intelligent in the back end. So there is no need for us to capture any sort of company specific risk premium, because the ultimate investor will not experience that risk. They will not experience it because in the back end, they would have diversified the portfolio. So that is the deeper thought process behind the Delaware court's, Delaware Chancery's judgment. And the company specific risk premium often seems like a device experts use to employ to bring their final results into line with the client's objective when other valuation inputs fail to do that. So it really hurts to listen to that, but I think it's some sort of a established secret that many of the times the valuers are also trying to cooperate with the client, especially when the transaction is finalized, when the investor has finalized on a particular valuation, and all we have to do is complete the paperwork in the back end. It happens, many a times we use the CSRP as the fudge factor. Maybe we can give different justifications, but that is what happens. Shilpa ma'am, I see your hand up raised. As soon as I finish the case laws, I will come to you, ma'am. You just keep your query in your mind. Yeah. And this is the last case law. This was the case law that established the fact that it called out on the hypocrisy of valuers of using the CSRP. In the case of Union of Illinois 1995, again, this was a judgment by the Delaware Chancery. A company-specific risk is not an addition to the CAPM that is accepted by corporate finance scholars. So that means if you go and speak to any of the purest CAPM users or the people, in fact, who invented CAPM and all of that, none of them are on line with the fact that you need to add anything to cost of equity. If you're using CAPM, that means you have eliminated unsystematic risk component from your mind, and then you are using it, right? So valuing the company to reflect the company risk. Pure proponents of CAPM argue that only systematic risk as measured by beta is relevant to cost of capital if there are concerns about projection risk. So the first 2 points we already discussed, right? That is CAPM investor is diversifying their portfolio. So no concept of unsystematic risk. So there is no need to bring in company specific risk premium if you're using CAPM model. Now, what the court further goes on to tell and gives advice to valuers and appraisers is, if you have concerns about the projection risk, because the projections were generated by inexperienced management or because of bias, all of that, it would be better for the expert to directly express their skepticism by adjusting the available projections directly in some way to make their reasoning come true. Like, for example, what they're telling is, if there is optimistic revenue growth, okay, what valuer has to do is they have to specify the reasons why they are skeptical about this such an optimism. They have to come up with their own interpretation and understanding of how much revenue will grow, thereby clearly justifying not just to the readers of the report, but also to the management. Look, boss, this is where I stand. This is what your company is worth. And these are the projections that I feel I am comfortable with. You have given a certain projection. I disagree with all of these things, and this is what I feel. And you can make your case very clear. So if I just add on a risk premium of another 20%, I will not be doing any service for either myself, or I will not be doing any service to the management, which has bias or inexperience. Neither I will be doing any service to the investors or any readers of the report. Because what I'm trying to do with recreating the projection is to tell which line item I disagree with. Is it the operational margins? Is it the revenue? Is it the indirect cost? Is it the marketing? Or is it any line item of how much capital as investment that they need? All of these line items, I can call it out. I can tell that I disagree, and this is why the cash flow should be lower if it is a very optimistically built financial model. So this is what Illinois court expected out of the valuers. Admittedly, this would involve as much subjectivity as heaping on to the discount rate. That means the subjectivity that is involved in CSRP, the same amount of subjectivity is involved in recreating the cash flow. However, it would force much more rigor and clarity about the expert's concern, right? The expert has a concern. If I use a fudge factor, that concern will not really be articulated very well. But if I recreate and make a scenario analysis of the cash flow, my concern as a valuer will be brought about in a much more articulated manner. That is what the Illinois case told us about. So with this, I would like to open up for a few queries. So there are 3 queries, one on chat box and 2 raised hands. First, I'll start with Shilpa ma'am, and then Chandrasekhar sir, and then the question on the chat box.
My point is with respect to the CAPM, usage of CAPM model.
Yeah.
vis-a-vis the diverse portfolio of the investor. But considering that, our valuations are more of compliance and it is supposed to be timing earlier to identifying the investor. So and the existing investors are a mix of promoters who are not having any diverse portfolio and one or two of, VC funding or angel investors. That is one scenario. Another thing is the new investors for whom I'm supposed to do this valuation or for whom this valuation is supposed to be used. As of now, I may not have any idea as to what kind of portfolio. So just some thoughts on it, if permissible, either now or in the end.
Right. So that will in fact be addressed. So what happens when there are different types of investors? Like promoters usually do not have diversified risk. Should I prepare a report keeping in mind promoters? Should I keep in mind prepare report keeping in mind private equity investors or retail investors? Who should I keep in mind? So does it also mean if the company specific risk premium keeps changing with every different type of investor or not? That is also a question to be answered. So of course, do not take the case law given here set in stone. The court is not in all of these situations. What the court is doing is it's expressing displeasure on valuers, but it by itself is not setting in stone the perfect way to compute the cost of equity or the perfect way to arrive at a CSRP. It is just disagreeing with all the methods that is being put forth by appraisers and valuators in front of it. So that is what we have to take. And it also helps us understand because in my little limited capacity, I did research with regard to Indian case laws. I couldn't come up with any case laws in India that criticized CSRP. And in fact, majority of the case laws either suggest that the registered valuer or chartered accountant are expert in their fields, and it is not the jurisdiction of court to question many of these things. Those are the kind of case laws that I came into. In fact, in case, with all the criticism going around, both in the valuers circle and in general public, especially with the failed IPOs and all, it may soon happen so that we as a fraternity may be subject to further more scrutiny. So these case laws and all will in fact help us to foresee what kind of activism by the judiciary may come up in the future, because the judiciary, I feel, till now in relation to valuations have been quite dormant and very accommodative of the valuer. So given the amount of subjectivity that is going into valuation these days, it may be up for scrutiny and we should probably be ready for it.
I'm surprised all this happened in 1995.
Yeah, that valuations in the US especially, it's in quite a mature stage, I feel. The professionals and all are very mature in their way of approach. Lot of scholars have come up in valuations in US. Case in point being Professor Damodaran. So, but there are many unsung heroes also in the back end. So, like Butler-Pinkerton of Butler-Pinkerton model. So, these are all unsung heroes. Yeah. Chandrasekhar sir, please.
Good morning.
Good morning, sir.
I think you partially answered my views also. The court, that company specific premium, instead of taking the risk specific premium going for adjusting revenues, profit models and other things. What happens as a valuer, we cannot just question the management projections. So what we do is when we take company specific premium is, after arriving all the numbers, we will take some average of whether is the impression whether management is projected as too optimistic or too pessimistic. Considering the industry standards or gut feeling, we will assign some rate. It is a weighted average of all factors. So going to the revenue model and also questioning CAPEX, profit models, expenses may be difficult. So that's my view is that CSRP has to be there, but that subject depends upon what is the percentage.
So those are the kind of things, which are heavily criticized by the court, because what the court ultimately tells is, if I am taking some sort of a gut feeling, average, weighted average, etc., all of that, it wants me to come up with empirical data to prove it. Okay. So if I'm not taking empirical data and if I'm not proving it, it also goes on to tell in a few cases that your judgment is very subjective and it is affecting lots of people, the investor and the company and the tax authorities. And there is no reason for us to really stick with your subjective assessment of the company, mainly because it is not backed by data. And if I tell you that this is not correct, you are not in a position to tell me that no, this is correct. So that is what the court is telling. So this is why it requires us to relook into it, even if it is a little tough, like modeling the cash flow, remodeling the cash flows. We still have to get it done, because if we don't start looking into it at these angles, the valuation profession will be watered down, is my opinion. So that is why I feel like we should pay attention and respect to these case laws.
One point is, as far as in the Indian judiciary is concerned, there are no precedents saying that
it will soon happen, I feel.
Yeah,
it soon happen, I feel, because there is a lot of criticisms that are coming around valuation, and it will be a hot topic after, in case something big happens, which when that is when there will be no other option but to step in. The NCLT will start stepping in this situation. So before I hand over to Nataraj sir to talk about a few qualitative aspects, I would like to leave you with one thought by Brierley, Myers, and Allen in the textbook it's given. Be careful not to offset worries about a project's future performance by adding a fudge factor to the discount rate. Fudge factors don't work, and they may seriously undervalue long-lived projects. So it gives also the other side of things, because valuers, we always criticize the company with being too overly optimistic and all. But what if the optimism comes through and they achieve it? We would have done a severe disservice by giving a lower valuation. Lower valuation ultimately means that their cap table is messed up. And if their cap table is messed up, the promoters initially, whoever started it, may not have the appropriate control over the company in which they want to run it. And we should also look at the fact that we might be stifling the future Tata or a Reliance or these days the Adani, right? So we have to be careful in coming to the judgments of whether it is optimistic or not. And if it is, we have to word it out properly rather than using a fudge factor. So what we are going to do next is, Gangadhar sir, please, you also say something.
Silpa and Anjan, if you permit me, I'll add something to Silpa's question.
Yeah.
So basically, Silpa has asked, since we are conducting regulatory evaluations, we don't know who is the valuer is and who is the investor, and then because of those factors, how to develop that discount rate, how to bring in those factors.
No, CAPM usage is depending upon diversity of the,
yes.
In that context.
Yes, CAPM usage. So the very fact that we are supposed to use the international valuation standards while conducting the valuations. So and you have to adhere to the basis of value or the standard of value. Normally in the regulatory evaluations, the standard or basis that was prescribed is the fair value or the fair market value. I am not going into the definition. See, so the fair market value always to be conducted, or fair value has to be ascertained on from the perspective of the investment or the project. Here the investment is the company. So when you are conducting your valuation exercise from the point of view of the investment, The assumption is always that the investor, you don't care about the investor's features. So whoever is the investor, you always assume that investor is well diversified and rational investor. He has full information with him.
Perfect, sir.
That is the assumption. So if you take investor into perspective in your valuation, if you bring in investors' requirements into the investor, the valuation of the investment, you have to follow the investment value. Normally, that investment value basis or the standard you apply in the deal setting, not in the regulatory valuations or in the valuation that is required for any other cases. You always follow the fair value. Fair value doesn't take into the features of the investors. It is always consider the factors that are risk factors or any other factor that are surrounding with the investment. We conduct our valuation from the point of view of the investment.
Yeah, there might be some disagreement from my end, because nowhere in any regulatory doesn't tell that we have to view the asset as a standalone asset in the portfolio of investor, or that we have to look at it as a standalone unit.
Yes, that's what I'm saying. What I'm saying. You cannot take, see, that when the investor point of view, he doesn't take that as a standalone asset.
Correct.
Investors from the investor perspective, you always assume that he is a rational investor. He is well diversified.
Yes.
So that is the reason you don't bring in CAPM model or any other models that you apply for development of discount rate.
Correct.
It is always assumed that all those factors which are from the perspective of a rational investor, that will be taken care. That has been already taken care in the discount rate.
Yes, Gangadhar. Correct. Yeah. Thank you, sir. Actually, I feel I'm with a wise person, Gangadhar sir. Thank you for
not only not me. This group is very wise. That is, we learn a lot from you. It is not.
Thank you, sir. Yeah. So now I would like to take the opportunity to hand over my session to Nataraj sir. He will speak about various qualitative aspects that go into this thing. So keep in mind that even though session from my end later on will be more of a numbers driven quantitative thing later on, you will slowly see how these qualitative factors also play a very important role in arriving at CSRP properly for our valuation engagements. So over to you, Nataraj sir.
It was Mr. Nataraj's idea to have this, one separate session on this. I'm really, happy that Mr. Nataraj has, brought forward this topic. It's time we ponder on this important aspect. All the thanks to Mr. Nataraj for raising this point.
Yeah, thank you, Shilpa. That discussion, what we had, really triggered into this subject. So this is very interesting subject, because I would say there is formula for most of the other factors. If you see in arriving at the overall discount rate, as well as the also the specific discounts, actually, if we are DLOM, there is most to the larger extent, there is a quantitative method. But CSRP, though there are some quantitative methods which Anjan will throw light on, most of us, and there are also qualitative methods which I am going to take you through. But if I can make a bold statement, most of us do not use or try to ponder over those qualitative factors, because of which it ends up as an adjustment factor. And what happens is, with that, we are in the risk of being in the eyes of the law. So I think it's a fantastic subject, and there's a lot when we try to research also to learn more and more. Not wasting too much time, we'll go into the session. Let me share my screen. Okay, my introduction has been done. So just to quickly add few things. So I totally come from the corporate experience working with various organizations like Infosys, Amazon, and Deutsche Bank and ADP. So I am into practice from last 2 years. So my views are coming from valuation perspective, as well as mostly from the corporate experience perspective, and also from the strategic and business point of view. So I think that really helps for this topic, especially company specific premium, wherein whenever we are actually doing valuation, we need to understand from the business perspective also. So having said that, I'm happy for any ideas from anybody and when we are in the session actually. So let me take it forward. Okay, so when we talk about risk types, Anjan has covered it, and this is something not unfamiliar to us. And there is something called systematic risk and unsystematic risk. Mostly systematic risk is covered in the beta, and also when we are arriving at CAPM to a larger extent. But unsystematic risk is where we need to step in, and that's where we are actually bringing in either discount for lack of marketability, or illiquidity risk, or company specific risk. So that's something we'll be addressing in this session. So not going very deep into it. So what we are talking about when we are actually saying CAPM covers, it's mostly arrived from the listed companies or public to measure the public company risk. So that's how, since we have the sufficient data in terms of the listing rates and everything, so we are able to arrive at the beta using the regression model, and we have the comparable public companies. So that's how we are able to ensure that we are arrive at the systematic risk using CAPM. However, if we want to talk about including unsystematic risk, so if we want to ensure that unsystematic risk is factored in, what we can use is the modified CAPM. So here the consideration is given for unsystematic risk, wherein we are bringing in the company specific risk premium, and also size related risk premium and industry risk premium. So this is something which is more enhanced by Duff and Phelps, and Duff and Phelps also publishes the company specific risk premium and market MCAPM in the US databases. So that is mostly relevant for US market, and I'm sure we will not be able to directly use it. However, we'll be able to research it and see if that can be adapted to the Indian scenarios. But company specific risk premium is actually published by using the guidance market comparables, and the analysis is done by Duff and Phelps. So here we are talking about company specific risk being measuring the unsystematic risk. And we say that there is no database, there is no empirical study, and there is no measurement model, and there is no formula. Here, obviously, we cannot say there is no database, because we do have some database in the US, which is the Duff and Phelps, and there are other databases like Morningstar and various other databases which are available. But it's not 100% accurate. So there is an element of unsystematic risk and company qualitative aspects which needs to be analyzed by the valuers. So there is some amount of empirical study, but however that may not be enough, and the research continues actually. So the measurement models. Now measurement models, if we see, there are some qualitative measurement models, and there are some quantitative measurement models also, which we will go through. So here we are saying that the professional judgment of valuer is important. So that's where I would say that understanding of the business is more important for the valuer. So I'll be touching more upon how what should be the valuer's mindset when we are talking about overall valuation, and as well as specifically with company specific risk, and also with respect to how to really look at the cash flows. So if Anjan clearly touched upon, if we are able to ensure that the revenue projections are appropriate, then whatever adjustments you are doing, if you are able to adjust in the revenue projections and the cost projections, then you really need a company specific risk premium. So what we are trying to say is, if we actually have inflated the cash flows based on whatever the client is providing to us, and if we are accepting as is, then there is a requirement of company specific risk premium. But however, having said that, is it possible for us to ensure that 100% analysis of cash flows and appropriate judgment of revenue projections may not be possible? So that is the reason why we need to bring in some amount of company specific risk premium as well. So that is something, let us look at it. So here, when I talk about mindset of valuers, so what I think is, I mean, someone was talking about investors' perspective is different from valuers' perspective, but I would say, yes, valuers do have to consider the regulatory aspect. But the reason why valuers have to consider investors' perspective is because investor is the person who is actually investing the money, and the risk associated is with the investment. So if you see the literature, company specific risk premium is coming into picture because it's mostly in the area of private companies. So in the listed companies, the chances of applying CSRP is far lesser than private company valuation. So in private company valuation, the role of investors is too high, and we need to understand what is the mindset of the investor. And being a valuer, we need to look at it from the investor. If I am investing in this business, what is it going to be fetching for me in next few years? So that is how we'll have to look at from the valuer's perspective. Now coming to the business understanding. So I think it is quite important to understand all these aspects of business, be it product, service, technology, market and marketing, and industry and business model, whether it is into B2C, B2B, other models. And one thing, I mean, I do have some examples which I will be sharing. There's an example I have taken, which is like the guidance company as Amazon, just for our discussion, because I also work there. So I'll be able to appropriately explain how we need to really look at the business model if we take guidance company as Amazon. Now, why I have mentioned guidance company is not just because of I'm talking about Amazon in these slides. I am talking about whenever you are actually doing any valuation, private company valuation. So it is always better to keep a guidance company or companies. Shilpa was asking a question on there are startup companies which come to us for valuation, and their product is very good. Even then, can we really compare them with larger companies like Paytm, Zomato, or some sort of companies? The reason I'm mentioning Paytm, Zomato is I also had an example of one valuation wherein it is into fintech area, and they wanted to compare themselves with Paytm. So obviously, in terms of the stage in which they are, there is a difference, and the revenue and all those things. But how do you really compare it? Just having a product, a fantastic product, will not suffice. So that's where there are various other factors which we need to look at in terms of the overall strategy, and various factors which we will be looking in the upcoming slides. So that is where when we take guidance company, we'll be able to compare each and every aspect of that guidance company with the company we are evaluating. Then we'll be able to easily score what is the company specific risk premium we are able to allocate for this particular company we are valuing. And the other thing is, which I want to mention, whenever you are doing a valuation, now that the e-commerce industry is evolved to an extent, every other service industry you see is actually necessarily going into e-commerce. So when the moment you are in the digital space, you have to be a technology company. So there is while product might have a manufacturing side of it, and also there is an element of technology side, but every other service industry is going to be a technology company. So that is something we need to be cognizant of, and we need to assess accordingly. And every other service industry, if it is in the B2C space and it is in the retail space, then it involves supply chain management. So we need to analyze how strong they are on supply chain management and how strong they are on last mile delivery. So these are some few specific things which I wanted to mention. And one more tool which we can use is that Michael Porter competitor analysis and competitive advantage and SWOT analysis. So we know that competitive advantage scoring system in terms of Michael Porter strategy, we have various competitive forces, supplier, customer, and competitor, and various other forces. That analysis, when you do, you will be in a better position to understand the company. And when we are talking about Michael Porter's competitive advantage, whether the company is trying to have an advantage through cost, or they are differentiating through product, or if they have any other differentiating factor, this is where you will be able to understand the company's unique success factor. So that is something, what is the USP of the company is something you will be able to understand. So as I mentioned, these qualitative aspects will not only help you to arrive at CSRP, but to understand the overall valuation, and also to really understand the projections, revenue projections, and question each and every revenue projection aspect, whether the cost projected is in line with the revenue projection. Most of the times we see that revenue is growing 100%, 150%, 200%. However, the cost allocated, the corresponding cost in terms of marketing, technology, employee cost is not growing in the same manner. So that is something we'll be able to question. So this is just a snapshot of what are the various business models in the market, which is evolved as of today. So if you understand what exactly is a marketplace, so currently, if you get into any business, that is going to be a marketplace business, because you are already on the you are already online actually. So social media, e-commerce is going to be something which you are going to use as your mode of marketing. So you will be in the marketplace. So you are using the marketplace. So what is marketplace? It is very simple. When you say marketplace business model, you are not necessarily providing manufacturing or having the doing that into the business which you are in actually. For example, if you take Uber is not having any taxes on they have not invested on the vehicles. They are only connecting the vendor and customer. So the moment you are able to connect the vendor and customer through your technology and your supply chain management system, then you are in the marketplace, and the scalability is very high. You will be able to scale very fast. Otherwise, if you are holding on to ensuring that you will do the core operations in terms of manufacturing or the specific service, then the possibility of growth is very less. And I would probably say, I mean, I may be wrong, but mostly it is correct, because Amazon is the inventor of marketplace. When in 2000, they started picking up their business just from book sales, and they enter the marketplace, and how they have become a very big, very large organization as of today is because they have adopted the marketplace strategy. Okay, so not talking too much about other business models, you'll be able to see this. So these are the various kinds of business model which are available as of today. This doesn't obviously cover all business models, because these are mostly in the service industry, and there are core manufacturing and traditional industries do exist, and they are also complemented with our e-commerce and digitization. So I did mention, I will take an example of Amazon business model so that we understand and deep dive into at least one business actually. So here we are talking about a business model wherein Jeff Bezos, when he was in the flight 20 years back, he just took a napkin and he actually draw the business model. So the same is currently also, I mean, makes sense. And that is what is the business model of the Amazon. So Amazon business model is very simple. They actually are customer obsessed. They want to do anything and everything for customer. And that is one of the leadership principle as well. And when we work with Amazon, we were all trained to be obsessed with customers. So they will give any amount of discounts, and they can actually pay any amount of penalty and give vouchers and everything to ensure that customer comes back. So that the main strategy is low cost structure, low prices. And similarly, they develop the traffic, and then they have seller selection. It's pretty simple. So that is how their business model is. So when we are analyzing any business model, so we should be very clear on how actually they are getting into the market and how they are going to penetrate the market. So that is one thing. So this is just a snapshot of leadership principles: customer obsession, ownership, invent and simplify, write a lot, learn and be curious, hire and develop the best, insist on higher standards, think big, bias for action, frugality, earn trust, dive deep, have backbone, disagree and commit, deliver results, strive to be Earth's best employer, success and scale, bring broad responsibility. The reason I have brought up something related to business is, as valuers, we always talk about formulas and functions and all expertise, but I think we should once in a while talk about business actually. We should bring in startup entrepreneurs, and once we had investors also in our meeting. So I think that's the reason I have brought up this slide, and we should talk about business so that we will be able to go hand in hand and understand business to do the valuation better. Now, I already have covered what exactly Amazon business model and what is unique about it. So, so basically, it's strong technology, leadership principles, and their diversification in terms of AWS Prime and etc., and strong on strategy, customer focus, not for profit. So I would like to mention that they are continuously making losses in some countries, and they have margins in terms of profitability is very less. And if somebody is trying to apply dividend discount model, they'll not be arrive at the stock price, because there is no dividend probably, or rather there is some dividends right now. Otherwise, they were famous for being in losses and still doubling and exponentially growing their stock price. So as you know right now, and in fact, they were the early examples of how cash burn will really help you to grow actually. So that's what other companies are adopting right now. So yeah, now I was talking about technology. So if we want to enable our business to achieve the goals, technology plays a very vital role in terms of your front-end business technology or your back-end technology to operate. Both areas, whenever we are analyzing the business, this is something we can analyze how sound you are technologically. So if somebody says, I have a good product, so what is your investment on the technology in next 5 years? is there a sufficient capex they have factored in for technology? And so that is something we have to see. If somebody says, okay, we are a technology company, we are a product company, if they don't have investment in capex sufficiently, or if they don't have investment in marketing and employee cost, key management personnel, that clearly says that they are not clear about what their goals are, and they are only fudging the cash flows and trying to arrive at the good valuation. So that's where we can question and ensure that the proper percentage of money is parked or allocated to the costings. So now I'm coming to the real qualitative aspect of companies arriving at the CSRP. So this is something prescribed by NACVA, and various factors are studied. So again, here also, I'm not going to go deep. I will directly show you the model actually, because I don't know, I might have consumed more time. So factors associated with CSRP prescribed by NACVA is competition, financial strength, management ability and depth, profitability, stability and earnings, national economic effects, local economic. All these factors I have already discussed while talking about Amazon. So here risks associated also is clearly described when it comes to functional analysis prescribed by NACVA. And so market penetration factors. So I would like to just take a minute on this, because whenever we are talking about a startup valuation or any valuation, we need to look at what is their market penetration strategy. If they are growing at 100, 150%, 100%, it's pretty important for us to understand, clear understanding of how they are going to achieve that customer acquisition. This is where we can go deep in market penetration factors. Now coming to how we are going to do the qualitative analysis. There is a documentation procedure for each and every qualitative aspect we are studying. So by documenting plus minus on this, assigning the scoring, we will be able to arrive at the CSRP. So these are broad parameters. Operations history, volatility of revenue and earnings. So this is, we have few factors which are positive and few factors which are negative. When you say positive and negative, whenever you are assigning a scoring, that actually means negative, because you are reducing the cash, you're reducing the valuation, and you are assigning, if you are assigning 1 point or 2 point for particular scenario or measurement factor, then you are adding the CSRP percentage. For example, operation history, volatility, revenue and earnings. If you see, I mean, if we are taking a startup, then the possibility is all 3 factors are negative. That means you are going to give 3 scoring, or you are going to give 6 scoring. If your scoring methodology is 1 for each factor, then it will be 3. Otherwise, you will be, if you are giving 2 marks for each factor, like operations history is 1 factor, volatility is one factor, and revenue and earnings is another factor. So then you will give 6 as the scoring. That means you already have come up to the 6% of CSR. You have assigned 6% of CSRP. So then you will move forward. So accordingly, you will be able to assign the scoring. Main thing is, when you are assigning the scoring, all those factors which I mentioned earlier needs to be kept in mind, and we need to document the procedure for in terms of why you are giving that scoring. So moving forward, lack of service line diversification. So if we are talking about any product or industry, how much diversified they are. So taking an example of Danzo, they were initially into delivery of courier, and then now they are into grocery delivery also. So they are going into diversification. That's how we can look at how diversified they are. So obsolete information technology system. So if we are, this is where I was talking about, are they investing enough in the technology, or if we are doing the valuation of something which is in the growth stage, then what is the investment they are going to put in terms of the technology systems? Even then, if it is obsolete, then you will have to give the scoring for this. Key employee dependency. So this is quite important in terms of what is the kind of management, and succession planning is something which is very important we have to look at. And pretty easy to look at is long-term contracts. How good in terms of the establishing the long-term contracts is something which defines you to ensure that you are able to assign the scoring. And we were talking about some technology and some ideas or innovation. That's where, do we have the copyright or trademark or put patents? This is something which will help you to do the scoring. Now coming to the scoring. So I have just taken an example of one of the startup which I did the valuation. So this was a new startup. So I have given 3 scoring for the first line item. The second one, I have given 1 scoring because the diversification has not started. Obsolete information technology system, I have not given scoring. That means they're positive on that because currently they have a very good technology. Key employee dependency, I have given 1 because there is some element of key employee dependency on promoters, and they need to still come up with a good strategy on their succession planning and also the employees they are going to hire. And other factors, because it's a startup company, they don't have positive scoring. So here the long-term contracts, ownership, license of proprietary, this is where positive scoring will come. That means if I assign long-term contracts 1 mark, and ownership license of proprietary patent 1 mark, then CSRP will become 3, 5 minus 3. Okay, the ones which are on the top are actually a negative scoring, while you are giving the positive numbers here, and the ones below the line items are the positive scoring. So that is how you need to use this tool. And if you see that material, I can share the material. There is a detailed procedure of how to document each and everything with respect to arrive at this scoring. That is not something I'm taking up here because that's very lengthy document. So I think, I don't know how much time I used. I rushed up. Any questions anybody has?
Sir, please.
Just one quick one.
Yeah.
This lack of service line diversification, that is part of systematic risk, no?
How is it? How will you provide? Okay, are you saying that will be covered in beta?
Yes.
If we are talking about private company here, beta may not be absolutely relatable, right? So that's something, that's where we can use this actually. I understand where you are coming from. If it is a listed company, obviously market sentiment will take care of that, and the listing price will be in such a way that if it is diversified, if they are able to make profits, then that will reflect on the market price. Otherwise it doesn't actually. That is true. But in case of private company, my understanding is that we have to factor in this.
No, even in a private company, the beta what we use for arriving at the cost of equity, whatever it is, that is again derived from the data from the listed entities, and then we lever it, unlever it, and use it for the cost of equity. So in a way, it is related to the listed entity when we are arriving at the beta.
True, but if you are taking the listed entity, though it is not absolutely comparable and data is not available for private companies, we are trying to do something to get that beta by using the methods available in the market, like Ashwatha Admodharan site and other things. However, that company which you are actually taking as comparable company might have diversification, but if this company is not having diversification, that needs to be factored in.
Okay.
So the three number.
The first one
Located for the
first
operating stream volatility. If it is, yes, the first line of item. I just want to say, if it is more than 12 months, then you should allocate the 3 or 6 or what. As you tell them, for each one, we have 2 marks.
No. As I mentioned, it is our prerogative, because whether for each factor, whether you want to give 1 or 2, you have to decide. You should be able to justify that, and you maintain the same thing actually. So that is something, or rather you change it also. So that is something, this is the tool, you can use it. So answering your point, when in the first, if some company has completed 1 year, still I would score it as 3, because 1 year you will not be able to, is not enough for operating history and revenue earnings.
Okay.
Sir, I
And
request the rest of the questions to be taken at the Q&A. I have very limited time and lot of things to cover still.
So if it is more than for 5 years, then still we can carry it or not?
Then you can give a lesser scoring. Obviously, 5 years in the business. That's why I mentioned new startup. 5 years, then you mention 1 or 2 depending on the scenario.
Okay. As a key implied dependence, just some little clarification required. Key implied dependence.
Sir, can we please take it up at the Q&A?
Okay, sir. No, sir. Okay.
Yeah.
Okay. Thank you, everybody. If there are any questions, we'll answer in the end.
All right. So now that we have seen the qualitative side of things, this is more of a qualitative approach, or you can say Ashwath Damodaran very famously tells that valuation is both an art and a science. That's how most of his valuation courses begin. But it's always to be more scientific and less art, and also in a very artistic way, you can say, tie up the qualitative things into a quantitative number will give us a more of a confidence. So you will also observe how through the computational model that I'm taking, it will also later on have to become an art and neatly tie up into what Nataraj sir has been trying to tell now. So the method that many of the valuer fraternity across in the Western society is propounding to be used for company specific risk premium is the total beta method, and a derivative of it helps us to arrive at something called as a company specific risk premium through Butler-Pinkerton model. So this is what we will be looking at now. It'll be a little computational intensive, and of course I cannot take you through a complete walkthrough of how it will work with a specific case study. That will take a session of its own. However, I will show you snapshots on, because I have already done computations to be presented here. So those computations I will showcase through you so that it can be looked into and criticized and discussed about. But I cannot take you through a complete walkthrough of it. So what is the total beta method? It was actually a method written in one of the journals by Professor Ashwath Damodaran himself, the man himself, right? So it's a measure that, see, beta is generally a systematic risk. There's no dispute about it, right? Now, what is this concept of total beta? The total beta is a Greek which is supposed to be indicative of all the risks that an asset in its standalone merit would have, right? So what does that exactly mean? For example, a promoter is there. He has not diversified his portfolio at all. He has completely dedicated himself for this company. Okay. Now this, because he has dedicated himself to this completely and he has put all the eggs in a single basket, there is a certain amount of diversity, lack of diversity risk that is there. Then there is a risk that is because of the size of the company. Larger sizer companies of the same industry, same characteristics will have better valuation rather than smaller companies. Or if I have to put it the other way around, smaller companies tend to give more return on investment than larger companies, which is proved through empirical data. There are studies and empirical data that have been undertaken, which prove the fact that smaller companies tend to have a faster growth rate than larger companies, right? It's even intuitively also we can sort of realize why it is, because the growth rate when something is smaller, even if it's a smaller number jump, the percentage of growth is higher, right? So that's what is happening between the developing countries and developed countries. But either ways, I'm going more into subjective things, but coming back to objectivity, empirical data suggests that smaller companies grow at a faster pace. So now if companies have to grow at a faster pace, there is if they're giving more return there, that means there is more risk also. That is the concept behind that risk return matching concept is there. So total beta concept also takes into account the size premium, and it also as a component, the total beta adjustment factor takes into account the company specific risk premium also. So we do not compute the total beta by adding company specific risk premium, size premium, and any other risk premium. We don't do that. In fact, we use the total beta to arrive at company specific risk premium as a derivative out of it, because we know company specific risk premium is a component somewhere over there, right? So now this total beta, how exactly it is arrived at is we take a look at the price movements of companies, right? And we remove the common characteristics that is experienced by the market and this particular stock together, which is a systematic risk or a derivative of a systematic risk, you can say. And what we are left with is the pure risk that is there. So we use the coefficient of correlation coefficient to arrive at this. So this is the formula. I'm not going to dwell deeper into the derivation of the formula because it's an intellectual topic of discussion requiring many topics to be looked into. But to summarize in brief, how is total beta computed? You take the levered beta of any publicly listed company, right? It's a publicly available information, or you can compute it yourself through the price movement of stocks and to the movements in the general market, and you can arrive at the beta. So usually for computation of total beta, a 5-year look back period is preferred. But many a times we may not get that. So the longest possible time we have to consider for the beta, levered beta to be taken. So, and then you take the correlation coefficient between the company and the market, and we divide that with the levered beta, and thereby we are getting a total risk that the stock faces throughout, right? So that is the total beta, how it is computed. Now, application of total beta adjustment is based on the context of the valuation, is what Professor Damodaran tells. If the valuation is for sale of shares other than in IPO or non-diversified investors, total beta adjustment may be used. So ultimately what he's telling is, if the transaction is where there is an explicit reasoning and understanding as that the investor in question or the transaction in question is for an undiversified investor, total beta would be the best. So total beta methodology is good for private company valuations that way, because in private company valuations, majority of the time, investors are not well diversified is an underlying assumption, but that can undergo a lot of discussions and arguments that I understand, but we will take up those discussions and arguments at the end of the session. Now, total beta will be higher than the market beta at all times. You cannot have a total beta lesser than the market beta, because understand this, market beta is a systematic risk. Total beta tries to capture the complete risk associated with the company, and ultimately this is the formula that we are looking at. The total cost of equity is equal to risk-free rate plus the total beta into equity risk premium. Looks like a typical CAPM formula. So the risk-free rate is fine. The beta, the total beta is further divided up into the size premium and CSRP, which are components of the total beta. So finally, the total cost of equity as per this methodology is risk-free rate plus beta into equity risk premium plus the size premium plus the CSRP. So this is how the total cost of equity is computed. And as you can see, solving for CSRP, all of these are fixed components. Risk-free rate is markedly available. Equity risk premium is also market data. Beta is also comparable guideline company properly levered for the risk for the company that we are handling. Size premium is through research reports. CSRP is the only unknown, right? So CSRP, so we are trying to make a case here that if we solve for the unknown, which is the CSRP, we will get the size premium. So ultimately, the CSRP is equal to total beta minus beta multiplied by equity risk premium minus size premium. So this approach has been accepted by the famous Delaware court. So the Delaware court has earlier done quite a bit of criticisms against CSRP. So when it was computed in a logical manner and showcased the fact that CSRP exists and it is always in positive, and they used the total beta method and the Butler-Pinkerton method, not just the Delaware court, a few other courts have also approved their approach done by valuers of listing. So now, how do we compute this total beta? Before I show you the practical side of things, I have already made a computation ready. I will just run you through it. I cannot do the computation from the beginning because this is not a hands-on session. So what are the steps to valuation when you're using total beta for private entities are? First one is we need to arrive at guideline comparable companies. I am not even including that in the steps because every valuer does that, getting guideline comparable companies. So now when you get the beta of guideline comparable companies, you need to segregate those companies based on the market capitalization that they have, whether they're large cap, mid cap, small cap. And we need to gather research reports which suggest what is the size premium experienced by each of these players. So large cap companies may experience very small size premiums, while a small cap or a MSME listed stock may experience very high, tremendous amount of size premiums. So we need to put across the size premiums, keeping in mind the various, what you can say, the decile points, because research reports are given that way. No, the largest to the smallest is ranked out through various deciles, that is quartile, decile, so deciles, and we have to come up with the proper reading of our comparable companies and the research report that we are using to arrive at a proper judgment of a decile and using of a size premium. Once we have the size premium, we have most of the inputs ready. I'm assuming you have equity risk premium and risk-free rate, everything ready for this computation. So now plug in the size premium and you use the you can build yourself a BPC calculator, that is a Butler-Pinkerton calculator, and input these amounts, and you will be left with the company specific risk premium of the comparable companies. You do not have company specific risk premium yet of the subject company. So now this is where what Nataraj sir has talked in the last 25 minutes comes into picture. All these subjective things, we need to look at our subject company and compare them with the comparable company where we stand. Like for example, diversification or spread across geography or product mix, product portfolio. All of these we need to compare our own company with comparable companies. I will show you also how it is done. The best way to do it is to collect risk management reports that are hosted in the annual reports. If you go through annual reports, you will see risk management report. So that risk management report, we have to refer and see what are the areas of risk that your comparable company is facing. And you need to bring in congruence of the risks, similar risks faced by your company, so that there is some sort of agreement between the CSRP of the listed company or the comparable company with your company. And then you need to flag off and identify risks which are not there in a comparable guideline company but is there in your subject company. So it basically eliminates us to start from 0% and come to some 25-30% later on through subjective assessments. It eliminates that, and rather it gives us one base guideline as to what CSRP you should have if the risk that you are facing is similar to the comparable guideline company, the same unsystematic risk is being faced. And I know I am going on the edge of telling almost that the CSRP faced by the same companies across industry is the same. No, I'm not telling that. If I take four comparable companies, one comparable company has issues with talent management, the other company does not. But you have both of these companies together for your assessment. It is not an industry-wide problem. Each company will have its own specific issues. You need to gather all the specific issues from all these companies, compile it together to frame your own company-specific risk. So despite me telling that you have to take the risk from comparable company, it is not an industry-wide risk. It is, you can say, a congruence of risks that are experienced by companies in the same sector. And finally, once you have done a judgment of this, your CSRP assumption will be very close to, not very close, rather it will be a very objective computation of CSRP, because you can back it up with both qualitative and quantitative documentation in the backend, thereby making your valuation report much more richer, right? So this is the proposition I'm putting forth now. My argument is total beta is a much better way and a much more mature way of arriving at CSRP. And let us look at how it is exactly arrived at, right? So I'm going to show you now only how total beta is arrived at. I'm not going to show you exactly for any case study how it is arrived. And I'll also show you how the qualitative aspects are looked at. You're able to see the Excel sheet, right? Can anyone confirm?
Yes. Yes, Babu.
Thank you, sir. So now what I've done is I've just assumed that we are doing a valuation for some sort of a IT based company. And I have taken 3 examples, 3 comparable companies. One is a large cap company with about 52,000 crores of market capitalization, a very large company. Then I have taken a mid cap company called Birlasoft, which has about 9,300 crore of market cap. And then I have taken Zen Technologies, which is a small cap company, which is about 1,350 crore of market cap. I have just taken the risk-free rate at 4%. I have not done any extensive research. You just take it as a plug-in number. Whatever is the actual figure, you take it. 6.42% India risk premium I've taken from Damodaran report, but I'm not telling that Damodaran is the best for equity risk premium. You can do your own computation for it. Now, so the size premiums also have taken. So how have I arrived at 2.8%, 5.7% and 6.2%? It is not a computed figure. It is a figure taken from a research report. Which research report? I have utilized the research report given by Inkwrt. Okay, let me see if I can share my screen on this. I'll share my whole screen so that wherever I go, you can see. Yeah, so this is that Inkwrt research India size premium study. I went through what their approach is on how to compute size risk premium. It looked fairly all right. I have not done a complete peer review of it, but I have only vetted the initial observations from how they have approached it. So it seems to be good. And this was the only report I have seen across the internet where the size premium study is done for various market caps. Okay, and this one limitation of it is it's not an updated report. It is only till 2021. The latest one, I have not come across it. Maybe they will release it soon, because August 2021 was when they released it for 2021. Maybe next month they may release it. Don't know. So over here, if you go through their research report, of course, much credits to the people who have worked on it, CA Sumit Kandelwal, CA Puneet Kandelwal, and Professor Divya Agarwal. Humble regards and my pranams to them for taking the pains to compile this. So basically here you can see they have taken a few comparable companies. They have used various statistical models, which are seem all right. I don't want to get into it because it's a thing of its own. They have ultimately done all of these studies, and finally they have given out this, right? So the largest of companies with a market cap of 150,000 crores has a size premium of about 2.8%. And they have made it as a decile analysis, and the smallest market cap they have assumed is of 39 crores, even though there are companies which with much more smaller caps. The 39 crore is the smallest that they have taken, and the smallest market cap has a size premium of 12.1%, which is quite high actually. Because when we consider alpha and all, I used to not take such high numbers, right? The CSRP, everything put together, wouldn't cross 30%. So 12.1% just being the size premium for me was actually an eye opener, and it made me rethink on various valuations I have done. So you can use this as a comparable, not as a thing, right? So now our comparable companies have certain market caps, 52,000 crores. So you can go through the decile over here and check which market cap and what type of size premium you have to consider. So this involves even more deeper considerations and all. So where you have to correlate, and you have to, I'm forgetting that term, but you have to basically do it to the extent of your size, right? So I have, based on that report, I have considered these size premiums. I have taken the levered beta, which is a publicly available information. And I have taken the price movements of the last 3-4 years over here, and computed, and also taken the Nifty's movement. And I have computed the correlation coefficient. I have used a simple formula that is available in Excel called Corel, which matches the basically correlation coefficient matches the returns as per Nifty and the returns day on day as per the specific guideline company. And once we have done that, we can compute now the total beta, right? What is total beta? It is the beta divided by correlation coefficient. So beta is in this case 1.44 in Tata Elxsi's case, and correlation coefficient is 0.415. Using that, the total beta I have arrived at is at 3.47, right? It is levered beta divided by correlation coefficient. So across all these companies, we were able to compute a certain total beta. Using the total beta, we get the total cost of equity. So, but please bear in mind, this total cost of equity is not a CAPM cost of equity. It's a hybrid CAPM. So do not use this total cost of equity that is computed here for the purpose of evaluation from the point of view of equity investments. That's a totally different thing, right? Here it is as a standalone asset class. What is the risk cost of equity that is there? If it's a diversified, if it is a part of a diversified portfolio, the risk will be a little lower. But since it is part of a standalone, the risk is a little higher, right? And based on this, finally, the CSRP is arrived at. It is nothing but the total beta minus size premium, minus levered beta, multiplied by the equity risk premium and reduced by the size premium. So ultimately solving for the unknown. The unknown, which is nothing but the company specific risk premium. So with this, we have arrived at company specific risk premium for Elxsi, Birlasoft, and Zen Technologies for their particular total betas, right? So this is the company specific risk premium. Do not compare one specific CSRP with another. The situations will be totally different. This is basically unsystematic risk. So by looking at this, you cannot tell that Tata Elxsi is not as good as Birlasoft. How is it? Tata Elxsi is such a big company. Birlasoft is such a small company. Don't do that comparison. It is just a rating done by the equity market as to what might be the unsystematic risk in this company. All right. At a systematic risk level, Tata Elxsi is much better, right? But at the unsystematic risk level, it looks like Birlasoft is doing a little better, or the market may not have looked into its unsystematic risk in such a deep way. Now, we have this. Where do we go from here? I will also showcase the presentation also, but to give you intuitively before only the concept of how it will happen, we have to look at Tata Elxsi's risk management report. There various risk items would be listed. Then Nataraj has also given various items of risk, qualitative risk. You need to plot out those qualitative risks and where they stand, right? Where Tata Elxsi has this kind of risk, or Birlasoft has this risk, or Zen Technology has that risk. You just have to, no need of doing any ranking, nothing. You just have to mention the kind of risks that are there. And then you need to also put your subject company beside these three companies and ask ourselves whether this company also faces that risk. Okay. Now, when you do the ranking, when you do a complement and see which type of risks it shares more with which comparable company, we need to take that comparable company and the very next comparable company. Like if our subject company is more close to Tata Elxsi and Birlasoft, it lies somewhere in between. We can come to some sort of an understanding that the risk premium lies somewhere between 6.8 and 10.24%. But other way around, if we realize that some of the risks faced by our subject companies between Zen Technology and Tata Elxsi, we can come to an understanding that our CSRP should lie somewhere between 10% and 20%. We need to see further now if there is any congruency with any specific company. If it is more towards Zen Technologies, you can meet halfway and come to say around 15%. But what it really does is you don't have to start from 0% now. You can start your CSRP and back it up with proper logic from 10% onwards rather than from 0% onwards. So let me now take you through the slides and I will show you through one quick example how exactly it is done. So you can see over here, I have taken one example from BVR, BVR resources. They have come up, they have very smoothly explained about all of this. In fact, I attribute most of these learnings that I have from BVR, and the cost of capital book is there by, I forgot the name, but yeah. So Shannon Pratt, yeah. So that book also has quite a bit of coverage. ACVA has good material on certain things. So this example is taken directly from BVR, and they are comparing here a brewery. The subject company is called Boyce Brewery, BB, and they have to compute the company specific risk benchmark. They have computed company specific risk through Butler-Pinkerton model for comparable companies. PMID, Sam, Hook are all comparable companies. And the way we did for Tata Elxsi and all, they also have arrived using the total beta method and Butler-Pinkerton model. Now what they have done is they have sort of seen across the comparable companies, what are the things. Like for example, Boyce Brewery has 6 different product beers. But PMID has craft beer, which is 57%, flavored batch soda is also there, which is not really beer, 11%. Then ale is there, which is about 32, in-house ale. So this is This is the product mix of PMID. Sam has 18 beers, 4 flavored malts, and 1 hard cider. And Hook has 9 beers, but nothing else. So 0 malts and 0 hard ciders. So all of these things, we need to see which it is closer to. So here, Boyce Breweries, you can say, is a little closer to Hook on this matter rather than on PMID and Sam. Brewery location, there's only one in Idaho for BB, and for PMID, there's also one in California. For Sam, there is 2, and for Hook, there is 2. Again, here you can see that PMID is closer to Boyce Brewery rather than Sam or Hook. So you give a ranking, not a ranking, you give a point for PMID in second one. For first one, you give a point for Hook. So like this, you have to build up a model like this, which has more risk. Product line diversification, BB has the most risk because it has, our subject company has most risk. Then moderate risk is with the Hook because they have only 9 beers. Less risk is with PMID, sorry, Sam, and then least amount of risk is with PMID, just how as we discussed. So we need to segregate based on these factual numbers, which is ranked higher, right? And we need to finally distribute the rankings between most risk, moderate risk, less risk, and least risk. And what is the ranking that each company gets, right? So most risk is, as of now, you can see BB gets the highest risk. Then moderate risk, PMID gets, and least risk, less risk is received by PMID, and the least amount of risk is SAM. So with this, we can see, SAM is the most, rather least comparable company because it has the least amount of risk, or the risk profile of SAM is very different from BB. So you need to compare which risk profile matches the best here. So it looks like Hook is a good risk profile comparable here because of the most risk BB and Hook have together. The rest of the things, moderate risk, less risk, plays a little lesser role because most risk is what is more important. So in our particular case study here, BB and Hook are very close, and as soon as Hook, the very next one that comes in the second very next is PMID. So our risk should lie somewhere beyond Hook and PMID as a baseline. So from there, we can come to some proper conclusion as to what might be our company specific risk. So these are the ranking of specific factors. Now, before I open up for discussion, I know there might be quite a bit. It's a huge concept. Some of the other FAQs, and I will also tell you what are the questions for which I don't know answer to, so you don't have to ask that question. I also need to understand, and if any of our learned members know it, you can please let me know. Other FAQs are, in case, what type of comparable company we need to take. Let us say if our comparable company is very thinly traded, can we take it for the purpose of total beta computation? Ideally, no, but if you have no other choice, you can take a thinly traded company. But if you're taking a thinly traded company, you have to use a methodology called sum beta to arrive at levered beta. How to arrive at sum beta is given in a textbook called SBBI 2008 Valuation Yearbook. So I have given it in the references. You can take a look at it at your own pace. Then CSRP can never be negative, and if you use this methodology right, you will never get a negative CSRP. If you are getting a CSRP negative in your computation model, that means your total beta computation is way off charts. You need to relook at your computation. Even the largest of companies, as I had told you earlier, ExxonMobil also has a positive CSRP. Now, what is the limitation of this approach? It is limited to the extent that CAPM approach is limited. If you have your own qualms of using equity risk premium, small company premium, or the beta and all of that, then those qualms are applicable to this approach also, because CAPM is the base for this. And also, while being the base for it, it also violates the concept of CAPM in a very bad way, because CAPM uses only systematic risk, while total beta is a total risk, including the undiversified risk. So total beta that way it violates the concept of CAPM. Now, critics of total beta also argue that there is no theoretical basis for this total beta as a measure of total risk. Now, why they give that argument is, if there is a total beta, I cannot really divide it between any specific risk that the company may be facing. So in other approaches of company specific risk premium, I can tell I have problems with the management, or the company's processes are not all right. So various things we can tell, or there is a key man issue, or there is the contracts are only with 1 or 2 customers, which there is a huge risk. So that is a direct approach where I take a specific risk and arrive at the CSRP. But here we are going the ulta way. We are computing the total risk. We are removing what are all the actuals and hoping that the remaining is actually CSRP. So that is the major criticism of critics of total beta. So it is not it's not the be all and end all, but courts have accepted it and rejected other subjective methods. So that is why this method is propounded by various Western valuer practitioners. Now, before I open up for Q&A, the answers to the question that I don't know are publicly available market data of share prices, etc. They have, see, whatever price data, price movements and return on price movements that we see is the price movement of the minority shareholders, right? Because the majority will always be with the promoters and stakeholders. I have not been able to properly come to a conclusion how using the minority shareholder price changes will affect the computation of my total beta, because minority shareholders would have gotten some sort of a discount on lack of control. So how do we quantify that? If I have adopted this discount on lack of, we have adopted the share price movements in the open market, should we use DLOC again after taking into account total beta? That is something that is sort of bothering me. So coming to which, the difference between pre-IPO prices and listing prices considers DLOM. That is one method to capture your DLOM, how much percentage to take. But the limitation on that is the fact that pre-IPO prices to IPO prices, the difference may not just be DLOM, it can be undiversified risk as well, because the promoters would have completely put their effort into this company, because of which there will be diversified risk, undiversified risk. So the differences may also be because of that. There is not really, we have to use proper judgment to differentiate DLOM and the undiversified risk. That is. This is the further reading that can be done. These are all the sources that I used to compile this presentation. So when I share this presentation, you will also get all the links and sources which I used personally to prepare this, and you can scrutinize the presentation and also do your independent study. So with this, I'm opening up for Q&A. I know we are overshotting the time, but if anyone wants to please ask anything, I'm open.
So movement of share prices, moneycontrol.com will get prices of the movements which were taken.
Yeah, I used investing.com. Money control also is used, but whatever you do, you always ensure to take the adjusted closing balance and not the share closing balance of that day. Adjusting closing balance helps you to take into account all corporate actions like bonus issues, splitting up of face value. All of that will be reflected in adjusted closing balance, but not in just closing balance.
So adjusting closing balance, how will you derive, sir?
It is there. It is there in the publicly available.
Oh, thank you, sir. Thank you, sir. Very wonderful, sir. Really enjoyed a lot, sir.
Yeah.
Thank you very much.
Thank you, Sanjay.
Really a lot of things we have learned.
Yeah. Thank you, sir. Thank you so much.
I request Kusum to formally extend vote of thanks on behalf of Bangalore Valuers Association.
Shilpa ma'am, any discussions I think we can do, no? Some 5 minutes.
Yeah, I want a quick, one quick question.
Yes, Naren sir.
Slightly controversial and not exactly related to the beta part, but company specific risk.
Right.
Okay, recently you would have heard that there was a valuation of Twitter of 44 billion, and then the deal may fall apart.
Twitter,
Because,
Elon Musk. Yeah.
Because
Right.
the data about the
Accounts, number of accounts.
Okay. This is a company specific risk. What I
Right.
would be interested in knowing is how did the, and this is just between us, and take it a little lightly, I'm not getting this thing. How would the valuer justify his early evaluation? What disclaimers he would have put over there?
Right.
Second question is, when the company specific risk can be so big, okay, there's no amount of adding to the risk premium which will take care of this. So
Right.
how do you, how does one handle it? So both the questions.
Okay. So first coming to the Twitter thing, no? Ultimately, Elon Musk faced the same issue a valuer would face. That is whether the data that we got was genuine or not. So if Elon Musk got a certain number of accounts as a data and the company has given the metrics on what is the monetization per account, that will be a very good factor for us to substantiate our workings. Of course, we would have taken management representation letter stating that the company abides or tells that these are the number of accounts and this is the monetization per account and this is the projection of this. So if we have mentioned that fact in our report, we would be saved and our report, I don't think, will be invalidated. But if we have not done that diligence, if we have just simply accepted their projections, whatever they give, that is when I think we will be in trouble.
Okay.
Right. Sir, second question, I want to sort of understand the question again. If the company specific risk premium is quite big, I didn't follow the second part of it.
No, okay. The question is like this, that this particular thing about the accounts being valid or bots or whatever is a company specific risk.
Correct.
And it has a very, very big impact on the evaluation. You cannot handle this kind of risk by adding to the company risk premium, because what will you add? You don't know about what, nor will you, nor will it really be addressed by tapering the projections or whatever. And in many of these cases, they don't even earn profit. So what happens if you taper the projections? That is the thing. So that was my question, that when you talk about company specific risk, it could be like the factors we discussed, but it could be something very fundamental like this.
Very true. So that is why, a very good understanding. I mean, I feel we wouldn't get in trouble mainly because a person like Elon Musk, who is a spaceship and an electric car expert, but not really a valuation expert, was able to call out the fake accounts in Twitter. I feel we as valuers should also look at enhancing our knowledge to sort of call out these issues at the time of valuation only. So, and when we specifically call out these issues and the company is sort of not faithful, we should establish the fact that we asked for it and the answer may or may not be faithful. And if we call it out in our report, nothing like it. And here I would like to take how beautifully the prospectus of companies which are going to get listed are put out. And there the risk factors they would have spoken and deliberated on. And if we as valuers are able to deliberate on risk factors like this in our valuation reports, and let us say we get the valuation of Twitter and we tell one of the biggest risk factors is the number of active accounts, and our valuation is sort of subject to, or our liability is warranted to the extent that the undertaking given by the company and we have limitation on actually inspecting the number of accounts, I think our risk will come down. And if it comes to the foray that during the course of our valuation that there is an issue here, then instead of looking at CSRP, we should look at how enterprise-wide implication, as you have rightly put out, sir, the projections have an impact. Because I don't think CSRP is capable to handle this kind of issue.
So Anjan, this is a continuation of my earlier this one. When you say unsystematic risk,
Yes,
as DLOG, and also CSRP. Are there any other components of unsystematic risk? And if so, whether all three may not be applicable for a particular valuation of a firm? There could be, can be a combination of one or two, or can it be all four or all three in a valuation? What's your experience on that?
So the best unsystematic risk was actually, of course, told by Nataraj sir. I will also show you again the PPT. Just a moment. So here you can see, like various things that are listed out as unsystematic risk. Product line diversification, location, number of location, distributors, location of sales, foreign currency exposure, management depth, controls and procedures, net operating loss carry forwards, pay earnout, all of this, if we follow some sort of a framework, I feel we'll be doing disservice to industry specific unsystematic risks. But rather, as I had told you, the best way to approach is one is to have a framework in place. And also secondly, by closely studying the management reports. And the key management report is a risk management report is a mandatory declaration that is to be done as per SEBI regulations. So in any listed comparable company in India, you will find in your annual report the key risk management reports. If you have done enough studies of risk management report in that industry, let us say 6, 7, 8, 9, 10, 12 companies, you will slowly get a grasp on, okay, this is my framework and these are the other special risks that this industry faces. And we need to bring all those risks into this particular table, like a tabular format, and see where we lie and where our subject company lies. So I think that is the best approach for understanding unsystematic risk.
Thank you.
I hope that answers Hari Krishnan.
Yeah, thank you.
Sir, one question to Mr. Natarajan sir. Sir, as far as reporting is concerned, what do you feel is the best practice on for company specific risk? What point should be covered in the reporting?
Senthil sir, as I mentioned, see, you asked the right question. What we would do is, if we are trying to use CSRP as adjustment factor, then we are not keeping the documentation of our analysis. So later stage, when it is asked by the authorities, we will not be able to substantiate. So better to ensure that whatever methodology you are using, like total beta method or qualitative analysis of CSRP, you need to do the deep study and ensure that that documentation is kept. That probably you want to call it as due diligence report or something. You can keep it with you, and that scoring you can do and ensure that will actually support your CSRP percentage, whatever you are incorporating.
Thank you, sir.
Yeah. If any other discussions are there, we can take it up, or we can wrap up the session now.
We can wrap up. Kusum, please go ahead and extend a vote of thanks.
Yeah, a very, very good morning to one and all who's present at the Saturday morning BVA meeting. It has always been my pleasure to be a part of Anjan's discussions, and today it has been, a double delight with Mr. Nataraj joining us in the discussion. It has been a very, very informative morning, and Anjan, true to his skills, he has actually decided, or he had created a framework of how to deliberate on this topic. And true to that, he has actually managed it very well. We spoke about there was an initial survey, and we spoke about what is CSRP, and he also took us through these case laws. And the initial thought process when we were going through the case laws was CSRP is something that we should not be using at all, based on those case laws. That's what was the initial feel. And then Mr. Nataraj, he spoke about the unsystematic risk and the considerations that need to be taken into when we are scrutinizing, and how do we go about scrutinizing these assumptions. And of course, Anjan Babu came back, and he spoke about a very new model. In fact, I had never heard of this Butler-Pinkerton model. He also not only gave a structured approach, he not only deliberated on the structured approach to the CSRP, he also took us through an example. And of course, he has always been kind enough to share all the material that he has used in this presentations, which I am very sure is very useful to all these participants. So I'm very, very grateful to Shilpa ma'am for having organized this session, and Mr. Nataraj for having thought through that this is a very important topic, and all the research to work that has been done by both the speakers in coming up with this wonderful topic. I just want to wrap up this session by thanking all the BVA participants, and with a concluding quote which says that risk is like a fire. If it is controlled, it will help you. If it is uncontrolled, it will rise up and destroy you. So I guess, as valuers, we just need to make sure that we have not only a qualitative, but a quantitative documentation to make the valuation report a very a rich report, and something that is, that will actually sail through in any of these, scrutinies. So, and of course, I guess, it is also very important point that I want to emphasize, that studying the management reports is very, very important in arriving at the CSRP. So thank you once again, BVA, the speakers and the participants for this wonderful session this morning. Have a great week.
Just wanted to add one line. Actually, I have done this presentation with AVP, and so I had prepared earlier. All the credit, or rather most of the credit, goes to Anjan, who actually probably has not slept last night. So I wanted to just mention excellent work by Anjan also on this whole thing, the way he has driven. And he has always done detailed analysis earlier also. That's why I appreciate his work earlier also. Thank you so much, Anjan.
Thank you,
for giving these insights.
Thank you so much, sir. My pranams to all the BBA members and the organizing committee. Thank you so much.
Taking this opportunity, I would request all the members to come up with your, ideas, with your specific points, so that we can debate among ourselves as to what is right or wrong, why we are choosing to go a particular way. So this is thanks a lot to Mr. Nataraj for raising this topic, and of course Anjan joined him. Really hats off, Mr. Nataraj. I appreciate your interest in taking up this topic.
Thank you. Thank you. We can continue this direction.
Shilpa, is BVA planning any physical session sometime in the future?
We will plan accordingly. We will take your inputs and then we will go ahead.
Thank you.
Thank you. Thank you all. Bye.
Bye. Have a good day, everyone. Thank you.